Hello, and welcome to the latest edition of the Quarterly View from Glassy Mountain Advisors. I'm Jordan Smythe, the founder of Glassy Mountain Advisors, and I appreciate your joining us now for this presentation. I'm going to begin by providing an overview of the stock market's continued recovery through the end of 2021. Then I'll review market conditions early in 2022 and our outlook. Following a drop in September over concerns about the Delta variant's impact on the economy, stocks recovered sharply through mid-November. By December, the Omicron variant had begun to spread, and stocks declined briefly before rising again to hit new record highs. The S&P 500 index returned 11.7% for the fourth quarter and 28.7% for the full year, including dividends. Stocks have fallen as we begin 2022, something I'll comment on in a few minutes. Major themes during the quarter were mostly the same as in previous quarters, with a few twists. First and foremost, COVID-19 persisted as the most important factor impacting the global economy and therefore the markets. The Omicron variant caused case numbers to surge well beyond previous levels. Fortunately, serious illnesses from Omicron have been lower than for previous variants, but the outbreak has still caused disruption, including travel cancellations, delayed school returns, and curtailment of other activity due to workers' illness and concerns regarding the safety of returning to work. Uncertainty regarding the strength of the economy was a second theme during the quarter. Consumer spending was robust, unemployment dropped significantly as the labor market strengthened, and corporate earnings reports for the third quarter beat high expectations. However, economists lowered forecasts for fourth quarter economic growth due to the uncertainty regarding Omicron's impact, as worker shortages and supply chain issues combined with signs that people were starting to curb some activities such as dining out and traveling. A third theme continuing in the quarter was the potential for changes in government support for the economy. The Fed began tapering its bond purchases to clear the way for interest rate increases, which are likely to begin in March of 2022. Meanwhile, political dysfunction continued. Congress was unable to pass the proposed major spending bill, forcing Democrats to start considering changes that would boost its prospects of passing. Finally, conditions abroad remained uncertain and mixed. The recovery in Europe continued, but Omicron-related shutdowns interrupted the momentum. The Chinese government took restrictive actions against technology and internet companies and implemented fiscal regulations to reduce borrowing, particularly in the property sector, and economic growth in China slowed to about 5% annually. As we enter the new year, investors are assessing these same factors and their effect on investment prospects for the coming quarters. The S&P 500 index fell about 9% in the first several weeks of trading in the new year, though it has since recovered somewhat and is now down about 5% from the beginning of January. We believe returns will moderate in 2022 after averaging over 25% for the past 3 years. Nevertheless, we are optimistic that stocks can recover from the recent drop and deliver attractive performance in 2022 and beyond, though we do expect more volatility. We think COVID-19 will stay atop the list of concerns, given its ability to create uncertainty and hinder economic growth. As the world increasingly adapts to life with COVID-19, learning to live with the disease and avoiding drastic shutdowns, we expect resolution of most of the supply chain issues that have hurt the economy and contributed to the rise in inflation. Specifically, progress toward elimination of shipping constraints and shortages of microchips and other key materials will likely help get goods moving more normally again. The ripple effect of these improvements throughout the economy should result in strong GDP growth in 2022. However, results will be more muted than they were last year when the economy rebounded from the sharp drop in 2020. Fourth quarter GDP growth of 6.9%, which came in better than analysts' estimates of 5.5%, may have stolen some of the rise from the first quarter of 2022. The Fed will continue to wrestle with its approach to monetary policy, trying to balance its sometimes conflicting goals of keeping inflation controlled and achieving full employment. The Fed has indicated its willingness to reduce the assets on its balance sheet, another method of decreasing monetary stimulus. Unemployment dropped to 3.9% in December, which is below the Fed's 4% definition of full employment and gives the Fed a reason to tighten policy. The Fed will likely increase rates several times this year, but interest rates should still stay near historical lows. And real or inflation-adjusted interest rates will probably remain negative for a while. We do believe inflation will fall from its current high levels as supply constraints ease and people return to work, and we're optimistic that the Fed will not need to hike rates so quickly as to choke the economy. Analysts are now forecasting S&P 500 index earnings growth of about 24% for the last quarter of 2021. Such a result would mark the fourth straight quarter of at least 20% earnings growth, reflecting the strong recovery from 2020's downturn. Analysts are calling for earnings to increase about 9% for the full year 2022, which would be a strong showing even if lower than last year's increases from 2020's depressed levels. We will be watching results, looking particularly for signs that the companies we own have been able to maintain profit margins by passing along price increases to customers or reducing costs. Global economies will likely continue their recovery from pandemic shutdowns. Vaccination efforts and central bank policy in Europe, Asia, and elsewhere will remain important factors affecting the rebound. Risks to ongoing recovery include political conflict, such as Russia's massing of troops around Ukraine and feuding between the United States and China. Also, the economic slowdown in China threatens to hinder the growth of other economies that depend on the Chinese markets for sales of raw materials and goods. As for current market conditions, we believe economic prospects are positive overall, and robust corporate earnings, strong consumer spending, and low interest rates should create a favorable environment for stocks in 2022. The price-earnings ratio for the S&P 500 index is about 19 times now, higher than its long-term average, but down from 21 times just several weeks ago. We believe stocks can continue their run from this level. However, we also expect the market to pull back periodically and are not surprised to see the recent downturn after a long period of mostly upward moves. Growth stocks, including those in the technology sector, could be particularly affected by higher interest rates, which reduce the value of companies' future earnings. We're still finding good opportunities to invest in stocks here in the United States and in both developed and emerging foreign markets. As mentioned in our previous outlook, we are limiting our bond exposure in the income portion of our portfolios. We continue to prefer the higher yields of dividend equities such as utilities, pipeline companies, real estate investment trusts, business development companies, and preferred stocks. Thank you for taking the time to join us. We hope you enjoyed this presentation. We welcome your questions, comments, or suggestions, and we hope you stay safe and healthy. Take care.